This is a quick video just to go through the part C of interpretation of accounts. I'm going to look at the last couple of questions and just kind of go through things, just kind of a quick breakdown. This again, so if the A is the formulas, the ratios, B is the analysis, and C then sometimes could be a mix of different things. This one here, we're given information where this company is acquiring a solar panel company with the following information. Based on information, calculate the current ratio and the asset test ratio. Now the two of these are part of the liquidity section. The second part of this is using the calculated figures, explain why it's important for Shannon PLC to analyse the liquidity position. Not much work will be needed for here beyond what you've previously done, because you'd already have experience of calculating the asset test ratio. The current ratio is current assets is to current liabilities. So you're looking at your current assets and adding them up, and you're looking at your current liabilities and adding them up. Asset test ratio, as you would know, would be current assets minus closing stock is to current liabilities. Creditors falling due within 1 year, that is. So it's basically just using information and being able to look at this and say, okay, closing stock is obviously current assets, current liabilities, current assets. So expenses accrued and expenses prepaid. So expenses prepaid, you'd always know if you prepaid an expense. So if you had light and heat that you prepaid in advance, you're owed the service. Therefore, this is an asset. So it's easier to think of prepaid. Accrued is another word for due. So this is expenses that you still have to pay. You owe the money, so this is a liability. As we said, asset, and bank overdraft being a liability. So you're basically just sorting into the information, getting your current assets, putting it to your closing stock. That's your current ratio. Getting your current assets minus your closing stock is to current liabilities. And that would be your asset test ratio. Quick thing on this, just a mistake sometimes people make. Your asset test ratio is your current assets excluding closing stock. Don't go not including it and then take it away. If you know what I'm saying, then ignore what I'm saying right now. But just basically, it's your current assets excluding your closing stock. You don't add up your current assets without including this and then take it away. The calculated figures explain why it is important for Shannon PLC to analyze the liquidity position. So we're looking at this here, and we can see, let's say that they have a current ratio of 1:1 and their asset test ratio is 0.5:1. Both would be bad. I'm just making those figures up. Why is it important to analyze the liquidity position? Well, I have a couple of bits here on liquidity. Liquidity is obviously the ability to pay your short-term debts. You'll state it's important because the ability to pay short-term debts if fall due. It's a good indicator of liquidity. Includes liquid assets only. There's different kind of parts here of liquidity that I have just information on it that you could use to answer this kind of question. Rising liquidity, so liquidity of 1.2:1 or something. Or asset test ratio is a sign of prudent management because it indicates that the firm has the ability to pay its short-term debts on time, and thus paying interest for late payments, and thus avoid paying interest for late payments enables it to avail of cash discounts for prompt payment. You're just using information that you'd already know about liquidity. Why is it important for a firm to be able to pay its short-term debts? So if they have a good liquidity, you're stating, okay, this is really good for Generate Limited. Shannon PLC would be happy with this. Liquidity is a sign of being able to pay your short-term debts in time. And obviously, basically, just kind of using the information and your knowledge around what liquidity is to answer this part. 2018, look at this one here, is a little different. This one is to do with kind of more of the activity ratios rather than liquidity. Born to Run PLC is considering expansion by purchasing a small sportswear company. It has obtained the following information relating to this company. There are 4 years of information. We have period of credit allowed to debtors. So a period of credit allowed to debtors is how long we are generally leaving our debtors go before they pay us. How long does it take our debtors to pay us? And a period of credit received from creditors is basically how long our creditors are giving us days wise on average before we pay back. So let's say last year they would have taken 34 days to pay back the creditors, and they would have waited 40 days to receive money from debtors. Stock turnover is the amount of times in a year that you buy stock and sell it. So if I was to buy stock every month and at the end of every month it was gone, I'd have to restock my shelf every month, which means I'd have stocked 12 times a year. Was obviously from 2017, maybe their stocks would last 2 months, and therefore they only need to restock 6 times. They want to turnover the amount of times you're continuously stocking up in 1 year. Analyze the information on the table above. What advice would you give Born to Run regarding this purchase? So what you're looking at here will be the trend. You'd be discussing what they mean, what these three figures mean, and you'd be looking at the trend and stating, okay, so over the last 4 years we have reduced the amount of time that our debtors are taking to pay us, and we have increased the amount of time that we are basically given allowance from our creditors. So both these are good, and our stock turnover is about 6 times a year. Stock turnover isn't as important. I have this answered here towards the bottom of your theory. Just wait for this here. So we can see here that the period, this is 2018, period of credit allows to debtors, as I said earlier, is how long it takes for debtors to pay us. So the trend is good. It's gone down. Liquidity will improve as we are receiving cash faster. However, the collection period to debtors is longer than the average period received from creditors. We would have seen that in the table. It's taking us 40 days to receive money and 34 days to pay it. So ideally, we'd want that to be below the creditors, but still the trend is good. The period of credit received from creditors, the length of time it takes us to pay our creditors, started off 14 days and moved out to 34, so it's positive again. We're being given more time to pay, which is important. The trend is positive. Liquidity improves as it takes us longer to settle our accounts. However, the business may lose out on discounts for prompt payment. It's just a general statement. It's not really that important. It's the idea that sometimes a business will say, look, if you pay us next week, we'll give you 5% off. If you wait 2 months, you'll add another 5% on. Stock turnover, rate of stock turnover disimproved, falling from 12 times 2014 to 6 times 2007. This trend is negative as it's taking longer to sell stock. Liquidity may disimprove as there is much more money tied up in stock coupled with falling sales. This is the idea here that you're 12 times here that we have to restock up and 6 times. Yes, there is a host of reasons why stock may be taking longer. Maybe it's because the stock isn't selling. Maybe it's because they have decided to buy more stock, which again may not help their liquidity. If you buy more stock, obviously it takes longer for it to sell out. Liquidity may disimprove as there is so much time tied up in stock coupled with falling sales. Yeah, obviously if you've paid for the stock previously and now you're waiting on it to sell, you're waiting on that money to come in. It means you generally probably have a lower amount of cash. So the fact that our creditors are taking, I suppose they're requiring us to pay sooner than our debtors are, and the fact that we aren't selling the stock as fast as what we were before, I would recommend not buying shares in Born to Run, or Born to Run buying in this company, whatever the company was called. Yes, sportswear company. We're not giving information. This theory part of this is given specific to 2018. I've done the same with 2 more years down there, whereas the rest of the theory section here is just going through the general information that we're generally asked. A lot of information there sometimes looks more daunting than it is, but a lot of it can be more common sense when you break it down. 2017, just to look this one here, we have done our ratios, we've done our analysis from a bank perspective. And the things we're asked here, so employees use financial information. If you're an employee of JB PLC, explain why the financial information of the company would be of interest to you. So from the same perspective that we always look at this from, let's say, an ordinary shareholder, a new investor, a bank manager, or a debenture holder, employees actually care about this stuff too. Okay, so explain why the information will be of interest to an employee. The second part is identify two users of financial information, which should be quite easy. Two users of financial information: lending institutions, debenture holders, for example, or banks who give us money; trade creditors who are waiting on how much our time it takes for us to pay them; shareholders, ordinary shareholders, new shareholders; the revenue would care, the government; our competitors would like to see us how we're doing; and directors, people who are involved in running the company. But straight away, the ones that should jump out at you are the fact that who uses the financial information, who cares? Well, we've always done shareholders, or new investors, and we've always looked at lending institutions too as well. So for banks and debenture holders, so the two of those should jump out. And in reality, if you just think about if you had a company, who would care about how your company is doing? Your competitors would be straight away quite important. The people you owe money to, and the people involved in the business, and the government obviously seem to care about everything. Why financial information is important to employees? Our first question, for job security, and that should be the big one. If you are working in a company and you find out that that company is making massive losses, what are you going to start thinking? Oh no, potentially I could lose my job down the line. So employees would care for job security, to see if their firm can continue to pay existing wage rates. So if the firm is struggling, you'd wonder, oh, am I going to get paid into the future? If they're doing well, maybe the firm is making loads of money, I could afford a pay rise. Pension security, if you've invested your in the company itself, for your pension, and to see if the firm plans to expand and thereby assess the prospects for promotion. If the firm is going to have the money to get bigger and was moving into a new market, maybe you could have a higher rated job somewhere else. I would say the big two being the first two here. Why would employees care about how the company is doing? Because it's their job, they don't want to lose it. Job security, and to see will they get paid into the future, or if the firm's doing well, they get a pay rise. So that's 2017. It was nice and easy. That there is the start of your theory here, the first two parts of the theory section. 2015 I'm going to look at, because I'll actually look at 2016 briefly as well. This is the second gearing question, our second ordinary shareholder question, and it's directed at gearing. Explain the term gearing. What are the benefits to having a low gearing? State two ways to reduce your gearing. So gearing is all about how much the company is financed by loans and money that we have to pay back into the future. So we have this here. What is gearing? Measure of how business is financed on a long-term basis. Measures the relationship between fixed interest debt, basically money you owe, and total capital employed, or equity, depending on which ratio you use. So when the gearing ratio itself, the debt to total capital employed, when this is less than 50%, the business is lowly geared, which is good, which means that most of your business is being financed by you yourself rather than by debt. And when this is less than 50%, it's highly geared. When this is above 50%, I'm going to have to, this is actually, yeah, I can't cut that out. I'm going to have to find a way to work that after. When this is above, or more than 50%, the business is highly geared, which is bad. The benefits of low gearing. So why would we care if a business is lowly geared or not? When we're lowly geared, it means that more of our business is being financed by ourselves, which means we don't have as much loans, we don't have as much loan interest to pay. So that's straight away a positive thing. When fixed interest debt, which means our loans and our debentures and our preference shares, is a small proportion of the overall capital, has the following benefits. We have low interest repayments, more profits available for investment elsewhere in the business, because we're paying less interest if we have smaller loans. Shareholders are more likely to get a dividend when gearing is low. Generally, if your interest rates are very high, you try to pay your interest rates at your profit. If your interest rates are very low, generally dividends get paid more. The firm should find it easier to raise additional loan finance. If you are already lowly geared, then there is more of a chance for you to get a loan from a bank. But if you already have huge loans, the bank is never going to give you another loan. There's less risk of liquidation due to not being able to make interest payments. So again, we're not struggling to pay back loans and loan interest, so we've less likelihood of struggling to have cash. Rising gearing ratio can prove dangerous, explain the loss of control. So obviously this is just more or less the inverse, the opposite of it. Um, we were asked as well for possible ways to reduce gearing, so sell more ordinary shares. Therefore, more of your company will be financed by shareholders investing, and therefore you'll have more control rather than the banks owning more of the business. Through loans, you'll have more of your ordinary shareholders owning the business. Reduce or repay loans. Once you pay back the loans, your gearing rate will drop and you'll be back to lowly geared. Or increase revenues, retain profits, which is easier said than done. Basically, make more money. Increase your profits, or reduce dividend payout. Pay out less dividends, and your profits will be a little bit higher because you're keeping the money internally in the business. That was the 2016 one. Again, I'm just going through these quickly. All this information is here. I just think it's some bit helpful if I kind of talk through and relate it to the questions rather than you just look at this going, I have to read this and I don't know what it means. 2015, the last one I'll do. This was the last time the new ordinary shareholder came up, the investor viewpoint. So this one was state the limitations of ratio analysis as a financial analysis technique. So the limitations of ratio analysis. What we're doing here is we're analyzing ratios. So that's ratio analysis. Limitations mean what are the potential drawbacks from it. Like what are the limitations of something basically? What can this sometimes struggle to show us? So what can ratio analysis sometimes struggle to show us for how a company is doing? Where have I this in the notes? I think, yeah. So up towards the top, this section here, and this is probably the most common question that's asked. Hasn't been asked in a couple of years. It will get asked soon. Limitations of ratio analysis. So what are the limitations of all of this? So we're using all historical cost data rather than current market value. If we're looking at well, bar investments, which sometimes can be kind of assessed a good bit more. I mean, we're trying to depreciate our vehicles. We're looking at our stock figures, and we're using the cost figures from what we would have paid for them. It's very hard for a company to rely completely on their historical figures. It doesn't give you a huge indication sometimes. For example, right now there's a recession going on. A lot of things, their value could have dropped. Some of their stock value will have dropped. And it's very hard for a company to know how much their value has dropped by. So a limitation of analyzing all this information sometimes is the fact that we're using historical data. Ratios do not show seasonal fluctuations. If you were an ice cream shop and you were looking at your ratios for the year, this ratio and this information here is not really going to show you how good you're doing in the summer versus how poor you're doing in the winter, because ice cream obviously isn't a high selling item in the winter. Firms use different accounting bases and therefore company comparisons are not accurate. I wouldn't say that as much as such. No, they generally most firms use quite a similar way of keeping track of their accounts. But the idea behind this one is basically that firms can show their accounting, basically their accounting stats, I suppose, in different ways, and sometimes it can be difficult to compare. It can be difficult to compare Nike versus Adidas, because Adidas show their accounts in one way, but Nike show theirs in another. In the last, I mean, that last came up in 2015, but I would say in the last 15-20 years, there's been much more standardized way of showing your accounts. And that's the thing about accounting. You'll have noticed everything is so structured. This is how you show your published accounts, profit and loss. It's this followed by this followed by this. And we keep things like that so that everything is the same and it's easier to compare between companies. But obviously it's not every company is going to be the same, so that is another limitation that you sometimes can't compare because they use different accounting bases. And the last one given here is that financial statements give limited picture of a business. Other important aspects of a firm are not revealed in financial statements. Accounts alone cannot measure aspects which can be extremely significant, such as monopoly position, economic climate, staff morale, or management staff relationships. Yeah, staff morale and management staff relationships obviously can be the downfall of any company internally. Monopoly position. So if you have a company, we'll just take one of the ones here. Let's say this one was a renewable energy company. If there is one renewable energy company in Ireland that is just after setting up, there's no other renewable energy company in Ireland. I mean, this information here mightn't be great. They might have low sales, but because they're monopoly, you're going to look at this and go, well, into the future, they have complete control. They're monopoly, basically meaning that they're the only company that are operating in their industry. And if you are in something like that, your prospects for the future are generally much more positive, because if this renewable energy thing was to kick off or to become popular, you're the person that's in control of selling this to the country. You're the one with the power. You're the only one operating in that industry. Financial information like the ratio analysis wouldn't be able to show you future prospects for a monopoly position and how powerful that company could be into the future. Economic climate, and case in point being the current COVID pandemic. The information we have here from last year is used to predict what we could have next year. There is no way that's going to run. If you think of this from a hotel perspective, think of the revenue that hotels, 960,000, let's say a hotel makes $1 million a year. Hotels are not making $1 million a year this year. Whatever they made before, they're going to make huge losses because obviously there's less people traveling. So information like this, because it's historic, it's not able to show you the current climate and how this could affect how the company is going into the future. So that's that one on limitations of ratio analysis. It does kind of change every now and then in terms of what comes up. A lot of the time, though, the part C is just basically using your own intuition. Like you may never have looked at part C before, and you could look at this and say, I'm just being asked to calculate the current ratio and the asset test ratio. I need to understand what the two ratios are, and the fact that both of them are looking at current assets and current liabilities. I need to sort out here what a current asset is and which current liabilities are there, and then I'm able to calculate the two of these. Once you're able to understand what we're writing about in the Part B section and what we're writing about liquidity, you understand how important it is for a firm to pay their short-term debts. So now when you're looking at this, you can say, okay, these companies have good liquidity because they are, their asset ratio is 1.2 is to 1, and they're able to pay their short-term debts. So you're basically stating why it's important to analyze the liquidity, because if you don't analyze this and if the liquidity is really poor, the firm could eventually have creditors falling due within the next 1 year that are much larger than their current assets, and they're likely to run out of cash because they'll be struggling to pay off their creditors. Again, it can differ each and every year, but I have quite a bit of information there on theory that should help some bit in terms of me going through it and relating to a question. But a lot of this is about basically being able to look through this and see which part of this is kind of relevant to the information you've done so far, be able to break it down and understand it and apply it to the question at hand.